Hey guys, welcome to today's video about stocks. In today's video, we'll be discussing the basics of the stock market for beginners, like how it works and just some basic terms. This is a very broad topic, so I'll be breaking it up into different videos. First off, stocks might be a little intimidating at first glance. You probably wanted to learn about the stock market because someone older than you told you to invest early, either from a conversation or a YouTube video, or you've heard that your friends are making significant profit. It's okay to feel confused at first because it can feel like a lot to take in. Whatever your reason may be to start investing, it's good to start off with the basics and then make your way up. So let's get started with teaching you the basics of the stock market. So what is a stock in the first place? A stock is essentially all the shares of ownership for a corporation. To understand this better, let's imagine a small business, say a lemonade stand. Jake owns this lemonade stand and wants to expand by opening more stands across his town. But he can't get a loan from the bank or a large amount of funding to do this. What he can do is he can go public. By going public, he gives investors the opportunity to own a small part or share of his business for a price. When investors see an opportunity in his business, they pay him money for a share of his business. And the term for going public is called IPO, or initial public offering. This allows Jake to do many things with the money he receives from people buying his stock. He can use that money to either develop new products for his stand, he can fund new stands across the town, or he can also give a small amount back to the investors. The amount of money given back to investors is called a dividend. And although businesses don't have to really do this, it's a really interesting way of holding on to investors and offering consistent profit for them. So there's two types of dividends. There's cash dividends, which are cash payments made on a per share basis to investors. So for example, if a company pays a dividend of 30 cents per share, an investor with 100 shares would receive $30 in cash. And then there's a second type of dividends, which are stock dividends. And these dividends are a percentage increase in the number of shares owned. So for example, say there's another investor who owns 100 shares and the company issues a 20% stock dividend, then the investor will have 20% more shares, which is 120 shares after that dividend. And usually dividends happen quarterly. So say Melinda is a friend of Jake who owns some shares of his business, and Matt wants to buy those shares from Melinda. Matt offers to pay twice as much as Melinda paid initially, and he purchases her shares. Now why does he do this? He does this because he thinks that they'll be worth more in the future, and then he'll be able to sell it for a greater profit. And that's basically the stock market. It's just people buying and sharing tiny pieces of companies based on what they think it will be worth in the future. But in real life, these exchanges are happening thousands of times per minute all over the world. The New York Stock Exchange here is the most popular stock exchange that occurs in the financial district of the lower half of Manhattan, more commonly known as Wall Street. It is by far the world's most largest stock exchange and has a market capitalization of its listed companies at $30.1 trillion. This is where the stocks of big traditional companies like GE and IBM are traded. And then there's a second stock exchange called the NASDAQ. But the NASDAQ is the younger brother and doesn't have a physical location. All the trading happens electronically. And this exchange is where you can find big tech companies like Apple and Microsoft. That's where they're traded. So in the US, when you want to know how both these exchanges are doing, that's where indexes come in. Indexes take all the share prices and output them into one clean number. Some index examples are the S&P 500, which tracks 500 of the largest companies in both exchanges, and then there's the Dow, otherwise known as Dow Industrial Average, that only tracks 30 companies that it thinks are the most important. Other companies also have their own indexes to measure their own stock markets. That makes a question. Why would you allow your company to be publicly traded in the first place? Like, for example, Earlier founders of companies or businesses would hold on to all their profits from their businesses. For example, Andrew Carnegie, who was an industrialist who led the expansion on the American steel industry, he kept all those profits to himself. Same with Cornelius Vanderbilt, who led the expansion of railroads across the country. They didn't allow their businesses to be publicly traded in the stock market. And now think of people like Bill Gates and Jeff Bezos, who could have held on to their profits from their companies when it was the first stages of development. Why didn't they hold on to all that money? Well, companies discovered that if you allow the public to buy shares of their company, you can grow a lot more faster. This is why most companies you know in today's world will have a stock in the stock market that you can purchase, also known as it being publicly traded. It also helps small businesses grow, which were once those big companies like Apple, Microsoft, Amazon, and Tesla. So if a company makes a bad decision, the shareholders will sell their shares, and that will drive the price down of the stock. But if the company shows a possibility of a possible payout, then people will be more encouraged to invest in risky ideas and buy more stocks. And that's the basic idea of the stock market as a force of good. It motivates companies to make good decisions, allowing them to give more money back to their shareholders and more money to grow their company as a whole throughout many jobs or expansion of facilities. And that's all for part 1 of understanding the stock market. In the second video, I'll be going more in depth, such as looking at the history of the stock markets, analyzing stock progression with companies, and a tutorial on how you can trade stocks. See you next time. I hope you enjoyed this video.